welcome to grade 12. Those who are doing accounting for the second time, you are welcome. Those who are also doing accounting for the first time, you are also welcome. And those who are doing accounting for the fourth, it doesn't matter, you are also welcome. I'll be looking at the basic concept of accounting. And then in this basic concept of accounting, it is very crucial and very important for us to understand the basic concepts that are applied in accounting, so that when we come to the calculation, we'll be knowing so what they mean when we are given those concepts, and we'll be knowing so how to apply them when we are doing the calculation. The book that I'll be using now, it is called Mind the Gap. And then in this book called Mind the Gap, we'll be doing the theory, which is the basic concept of accounting. The first term that we look at is called accrued expenses or expenses payable. What does that mean? Expenses that are still owing at the end of the financial year. What does this term really mean? It means that as a business or as a company functioning, we can still have expenses that are not paid during our financial period, and those expenses will record them under accrued expenses or expenses payable. The next term is called accrued income or income receivable. What does this mean? Income that is still owing to the business at the end of the financial year. What does it mean? As a business, there are income that we can still be owed in the business, and those income, when we record them under the accrued income or income receivables, such as rent income. If we are a business and we are renting out an apartment, or we are renting out a land and buildings, and then when that person pay us back or pay us later in the financial year after we've closed those books, we'll record this as under accrued income or income receivable. And what the next term is assets. What are assets? Item of value owed by a person or business which enables a profit to be made. What does it mean? Assets are the things that a business are having, the things that are under the name of the business, and then those things, as we are having them, or as they are under the name of the business, they are making profit for the business, such as vehicles, such as land and buildings, such as equipment, and then those things will be making profit for the business. And then bad debts. Debts written off as the debtor are unlikely to settle their account. When we are a business, we can give things to people, or we can give. Let's make an example with an account. When you open an account and you go to a shop and you take things using that card, with that card, and then let's say now there's an incident where you are no longer working, or there's an incident where someone passes away who's owning that card. Now those things will record them under bad debts. Then we have cost of sales. What are cost of sales? Cost of sales is the cost price of all goods that have been sold. When we are a business, we go to a shop and then we buy things, and then after buying things, we buy them to resell them in our business. When you buy them to resell them in our business, the money that we use to buy those things initially, we record those things under cost of sales. Then we have creditors. What are creditors? People